Assalamualaikum and good day everyone. I am Yasserji Bashir and today we will be discussing the primary markets under underwriting securities. There are two types of markets. They are the primary market and the secondary market. Financial markets can be categorized as those dealing with financial claims that are newly issued, called the primary market, and those exchanging financial claims previously issued are called the secondary market or the market for the seasoned securities. But in this chapter, we will focus on the primary market for securities. The next chapter covers the secondary market. The primary market involves in the distribution of investors of newly issued securities by central governments, their agencies, municipal governments, and corporations. So we have the participants in the marketplace that work with the issuer to distribute newly issued securities are called the investment bankers. So in this chapter, we will explain the various ways that investment banking firms are involved in the issuance of new securities, the regular of the primary market, and the private placement market. We have the traditional process for issuing new securities. The traditional process in the United States for issuing new securities involves investment bankers performing one or more of the following three functions, which is the number one, devising the issuer on the term and the timing of the offering, number two, buying the securities from the issuer, and number three, distributing the issue to the public. The advisor role may require the investment bankers to design a security structure that is more palatable to the investor than a particular traditional instrument. So for example, here is the high interest rates in the United States in the late 1970s and in the early 1980s increased the cost of borrowing for the issuer even in the highest quality rating. So to reduce the cost of borrowing for their clients, investment bankers designed a securities with characteristics that were more attractive to the investors but not to the unirose issuers. So in the sale of new securities, investment bankers need not undertake the second function, which is the buying securities from the issuer. An investment banker may merely act as an advisor or distributor of new security. The function of the buying the securities from the issuer is called the underwriting. When an investment banking firm buys the securities from the issuer and accepts the risk of selling the securities to investor at a lower price, it is referred to as the underwriter. When the investment banking firms agrees to buy the securities from the issuer at a set price, the underwriting arrangement is called as the firm commitment. So in the fee earned from underwriting securities is the difference between the paid price to the issuer and the price at which the investment bank reoffers the security to the public. This difference is called the gross spread or the underwriting discount. Numerous factors affect the size of the gross spreads. There are two important factors are the type of security and the size of the offering. The major types of offerings can be classified as the initial public offering, secondary common stock offering, and the bond offering. So we have here also the initial public offering or the IPO. It is the common stock offering issued by the companies had not previously issued common stock to the public. So before we proceed to the following topics, we have here the key points that we should consider or understand before we go. So there are three types of functions by the investment bankers in offering new securities that was mentioned before, and they are the advising the issuer to the terms and the timing of the offering, buying the securities from the issuer, and lastly, distributing the issue to the public. So depending the type of the underwriting agreement, the underwriting function may expose the investment banking firm to the risk of selling securities to the public at a price less than the price paid to the issuer. The third one is the gross spread earned by the underwriter depends on the numerous factors. And lastly, because of the risk of associated with the underwriting of securities, an underwriting syndicate and a selling group are typically formed. Regulation of the primary market. Underwriting activities are regulated by the Securities and Exchange Commission, or also known as the SEC. The Securities Act of 1933 governs the issuance of securities. The Act requires that a registration statement be filed by the SEC by the issuer of a security. The type of the information contained in a registration statement is the name of the business of the issuer, the key provision or the features of the security, the nature of the investment risk associated with the security, and the background of the management. So we have also the financial statements must be included in the registration statement and they must be certified by an independent public accountant. The registration is actually divided into two parts. We have the prospectus, which is the part that is typically distributed to the public as an offering of the securities, and the part 2, which contains a supplemental information which is not distributed to the public as part of the offering but is available from the Securities and Exchange Commission upon request. The Act provides for penalties in the form of fines and or imprisonment if the information provided is inaccurate or the materials information is omitted. Moreover, investors who purchase the securities are entitled to sue the issuer to recover damages if they incur a loss or a result of misleading information. The underwriter may also be sued if it can be demonstrated that the underwriter did not conduct a reasonable investigation of the information reported by the issuer. So we have here the most important duties of an underwriter is to perform the due diligence. The following quotation comes from a court decision that explains the obligation of an underwriter to perform a due diligence. So we have here the quotation from the court. An underwriter, by participating in an offering constructively, represents that statements made in the registration materials are complete and accurate. The investing public properly relies upon the underwriter to check the accuracy of the statements and the soundness of the offer. When the underwriter does not speak out, the investor reasonably assumes that there are no undisclosed materials deficiencies. The representation in the registration statement are those of the underwriter as much as they are those of the issuer. So the filing of the registration statements with the SEC does not mean that the security can be offered to the public. The registration statement must be reviewed and approved by the Securities and Exchange Commission's Division of Corporate Finance before a public offering can be made. The staff of the division will find a problem with the registration statement. The staff then sends a letter of comments or deficiency letter to the issuer explaining the problem. So the issuer must remedy any problem by filing an amendment to the registration statement, and if the staff is satisfied, the SEC will issue an order declaring that the registration statement is effective and the underwriter can consolidate sales. So the time interval between the initial filing of the registration statement and the time the registration statement becomes effective is referred as to the waiting period, or also known as calling off period. During the waiting period, the Securities and Exchange Commission does not allow the underwriters to distribute a preliminary prospectus because the prospectus has not become effective. Its cover page states in this red ink, and as a result of preliminary prospectus is commonly known as the red herring. During the waiting period, the underwriter cannot sell the security, nor may it accept written offers from the investors to buy the security. So in 1982, the Securities and Exchange Commission approved the Rule 415, which permits a certain issuer to file a single registration document indicating that they intend to sell a certain amount of a certain class of securities at one or more times within the 2 years. Since the Rule 415 is popularly referred to as the shelf registration rule because the securities can be viewed as sitting on the shelf and can be taken off the shelf and sold to the public without obtaining additional securities approval. And before we proceed, we have a key points that we should consider. First is the Securities and Exchange Commission regulates underwriting activities. Second, an issuer must file a registration statement, one part which is the prospectus, and the second part is not shown in the public. Number 3, the underwriter must exercise due diligence to assure that there are no misstatements or omission of fact in the registration statement or the prospectus. And number 4, we have the Securities and Exchange Commission Rule 415 or the Shelf Registration Rule gives greater flexibility to certain issuers by permitting them to file a single registration document for the offering of certain securities at one or more times within the next 2 years. Variation in the underwriting process. Not all deals are underwritten using the traditional syndicate process we have described. Variation in the United States, the auto markets, and the foreign markets include the Bath deal or the underwriting of bonds. The auction process for both stocks and bonds underwrites of the offering for underwriting common stock. So we have here the broth deal. The broth deal was introduced in the Eurobond market in 1981 when the Credit Suisse first Boston purchased from the General Motors Acceptance Motors a 100 million issue without lining up an underwriting syndicate prior to the purchase. So we have also the auction process. Another variation for underwriting securities is the auction process. In this method, the issuer announces the term of the issue and the interested parties submit bids for the entire issue. The auction form is mandated for certain securities of regulated public utilities and many municipal debts obligation. It is more commonly referred to as competitive bidding underwriting. So we already know what is a bidding, and for those who have the highest bid will get the product or the share of the auction. So for example, suppose the public utility wishes to issue $100 million of bonds. Various underwriters will form syndicates and bid in the issue. The syndicates that bids the lowest yield or lowest cost of the issuer wins the entire 100 million bond and the issue and the reoffers it into the public. Primitive rights offering. A corporation can issue new common stock directly to existing shareholders via a primitive rights offering. A primitive rights grant existing shareholders the right to buy some proportion to the new shares issued at a price below market value. The price at which the new shares can be purchased is called the subscription price. For the shares sold via a primitive rights offering, the underwriting services of an investment banker are not needed. However, an issuing corporation may use the services of an investment banker for the distribution of common stock that is not described to. A standby underwriting agreement will be used in such instances. This agreement calls for the underwriter to buy the unsubscribed shares. The issuing corporation pays a standby fee to the investment banking firm. The value of the right can be found by calculating the difference between the price of a share before the rights offering and the price of a share after the rights of the offering. So we have actually an example in the book, so I did not included it because it will be too long. So if you're interested in solving it, you can just go to the PDF of of the PDF posted in the previously. And that, so we have here the formula: value of a right is equals to price before rights offering minus price after rights offering. Or equivalently, we have the value of a right is equals to share price rights on minus the share price X rights. So this is used in order to get the value of a right. So we have alternatively, the value of the right can be found also as follows. We have the price after rights offering minus the subscription price divided by the number of the rights required to buy a share. And specifically, distribution effect is equals to discount percentage divided by 1 plus the ratio of all new shares. So before we proceed, we have the key points that we should consider. Number 1, there are variation in the traditional underwriting process. Second one, in both deal, a lead manager or a group of manager offers a potential issuer of debt securities a firm bid to purchase a specified amount of security. And number 3, an offering of a new security can be made by means of an auction process. And lastly, a corporation can offer existing shareholders new shares in a primitive rights offering. And also a standby underwriting arrangement, the corporation can have an investing banking firm agree to distribute any shares not subscribed to. Private placement securities. So in addition to underwriting securities for distribution to the public, securities may be placed with a limited number of institutional investors such as insurance companies, investment companies, and pension funds. So the private placement, as this process is known, differs from the public offering of securities that we have described. So the life insurance companies are the major investors in private placements. So we have the Securities Act allowed 3 exemptions from federal registration. First is the infrastate offerings, and that is the securities sold within a state. Second, there are small offering exemption. And specifically, if the offering is for $1 million or less, the securities need not be registered. And finally, in the Section 4 of 1933 Act exempt of the registration, transaction by an issuer not involving any public offering. So at the same time, the 1933 does not provide specific guidelines to identify what is a private offering or a placement. So the guidelines that determine if the issuer is qualified for the exemption registration. So in general, the securities cannot be offered through any form of general advertising or general solicitation that would prevail for public offering. And most importantly, the guidelines restrict the sale of securities to sophisticated investors, such as accredited investors are such accredited investors are defined as those who have the ability to evaluate and and have the resources to bear the economic risk. So the exemption of an offering does not mean the issuer need not disclose information to potential investors. So let's go to the Rule 144A. In the United States, one restriction imposed on buyers of private placed securities is that they may not be resold for 2 years after acquisition. Thus, there is no liquidity in the market for that time period. The buyers of private placed securities must be compensated for the lack of liquidity, which raises the cost to the issuer of these securities. In April 1990, however, the Securities and Exchange Commission Rule 144A became effective. These rules eliminate the 2-year holding prior for permitting the large institution to trade the securities acquired in the private placement among themselves without having to register these securities with the SEC. So we have here the key points. A private placement is the distribution of shares to a limited number of institutional investors rather than through a public offering. The SEC specifies the condition that must be satisfied to qualify a private placement, and the investment bankers will typically work with the issuer in the design of a security of a private placement and line up the potential investors. And lastly, the Securities and Exchange Commission Rule 144A improves the liquidity of securities acquired by certain institutional investors like a private placement. And that is all. Thank you.